Welcome, my name's Jeff Driver, General Manager Business Development and Investor Relations for Australian Foundation Investment Company. I have with me today Mark Freeman, who's the CEO and Managing Director, and David Grace, who's the Portfolio Manager for Australian Foundation Investment Company. Mark, we've just announced our results. Got some comments around that?
Sure. Well, I'll just give a summary of the results, a bit of an overview, then I'll pass across to Dave to talk about the activity in the portfolio. The full year profit was $285 million, down from $296 million in the previous corresponding period. The decrease in the profit from last year was primarily due to lower dividends as bank holdings were trimmed. The final dividend was maintained at 14.5 cents per share fully franked, but importantly, a special dividend of 5 cents per share has also been declared. This reflects the significant amount of realised capital gains and franking credits generated from the trimming of our holdings in Commonwealth Bank of Australia during the year. Total fully franked dividends applicable for the year, including the special dividend, are 31.5 cents per share, an increase of just over 21% from the previous financial year's total fully franked dividend of 26 cents per share. The portfolio returned 10.7% for the financial year in comparison to the 200 accumulation index, which increased 15.1% when you include the benefit of franking in both AFIC's performance and the index performance. In comparing those one-year numbers, a number of quality companies that AFIC holds in the portfolio underperformed the market during the year. David Grace will talk about this shortly. The management expense ratio remains extremely low at 0.16% with no additional costs or performance fees. So with that, I'll pass over to David.
Thanks, Mark. David, what were the sort of major drivers of the portfolio performance for the 12-month period?
Yeah, sure, Jeff. So I'd call out 4 factors that really drove that. And the first was a number of quality companies that we feel the long-term opportunity remains undiminished, but really saw some short-term headwinds. So that was the likes of Reece, James Hardie, ARB and CSL. And in fact, that gave us the opportunity to add to the majority of those during the period. The second point I'd call out is our portfolio positioning being underweight CBA, which had a really strong year with the CBA share price up 50%, far exceeding the earnings growth that they delivered in the last 12 months. And we were overweight CSL. So CSL underperformed the market where the share price fell 18% last year. And this is a company where we see strong earnings growth for the medium to long term, and certainly expect over the next few years they'll be able to deliver double-digit earnings growth. So we feel comfortable owning that over our investment time horizon. The third point I'd call out is the positioning or overweight in IDP Education, which had a really disappointing year. And this company saw earnings fall quite materially as government policy got tighter on student migration. And it's just a really painful reminder, again, just of any business model is dependent upon favourable government policy and the impact that can have on the earnings profile if that is actually reduced in any one particular year. And the last point I'd call out is just the portfolio having minimal exposure to the gold and insurance sectors. Both sectors performed really well in the last 12 months. And when you look over our investment time horizon being long term, both have proven to be deeply cyclical and really struggled to maintain a return above their cost of capital. So for that reason, over our investment time horizon, we can find better places to be able to put that capital and get better returns in our view.
Thanks, David. So you touched a little bit on the sort of changes that were made in the portfolio over the last 6 to 12 months. You sort of call out any particular stocks that you were focusing on or what the major changes were?
Yeah, so the starting point is that we're long-term holders in quality companies. So we're looking to own companies over the very long term and really seek to benefit from the power that compounding returns provide. However, there are times when valuations do get to extreme levels and we look to reduce those to be able to recycle the capital into buying opportunities as and when they present. So in that regard, we trimmed CBA, as I mentioned. We also took some capital out of Wesfarmers and JB Hi-Fi, and also trimmed Coles, Transurban and Telstra, following strong share price performances for all those companies. On the buy side, we're able to add to our holdings in Goodman Group and NextDC. Now, both are producing data centres or developing data centres where we see the demand remaining particularly strong. And there's a period of weakness where we're able to add to those. We also added to CSL and ResMed. We added to James Hardie, ARB, IDP, and we also participated in the rights issue from Mirrabooka, which is our mid and small cap fund. In terms of new companies to the portfolio, the only new holding in the last 6 months has been Telix Pharmaceuticals. So this is a company operates in the radio pharma space. Their unique delivery means that they're more targeted in attacking the cancerous cells and doing less damage to the healthy tissue that's surrounding the cancerous cells. So in that regard, we see the business having a significant opportunity to capture further market share. The business has developed a large commercial infrastructure and has a strong pipeline of future products coming to the market. So we expect significant earnings growth in this company over the medium to long term.
Okay, thanks, Dave. So, Mark, there's been quite a divergence in sector performance and company performance in terms of share price over the last 12 months. Sort of where's that leave us for the next 12 months in terms of your thoughts?
Yeah, look, it's been a remarkable year to see stocks like the banks and particularly CBA. And we think CBA is a fantastic company. It's got an incredibly strong position in the Australian market. It's extremely well run, but it's one of the more unusual things I've seen in my time to see a bank stock get to a PE of nearly 30 times. So, that's not the company's making, that's the market pushing up the price. So to see these sort of levels, we just find it very extreme. I think it's just weight of money going into these stocks, and I think Wesfarmers is a part of that. And again, we think Wesfarmers is an unbelievably good business, but just the valuations just look so extreme. We just felt compelled to take some off the top. That can have a short-term impact on performance, but we think it's the right positioning for our shareholders long-term. So I think that's probably highlights again just the overall valuation in the market as well. So if you stand back and say, I tend to look at 25, 30-year numbers, the actual valuation on the Australian market and the US market, if you look at the PE or a price to sales or a price to book or dividend yield, they're all pointing to pretty extreme valuations. Now, I was always taught you can't really predict the market, and I think that's true. But when you get these sort of extremes, I think there is, you have to stand up and take notice and be quite cautious, because it does feel like money's chasing assets at this point. And so we've got a fairly cautious lens on the overall market. But what we've got to be able to do is go back and say, are we holding good quality companies, whatever happens? And certainly the answer to that is yes. And that's the test we have to keep doing. We're going to reporting season, and that's a test we have to keep asking ourselves. Are they good companies? Do they have the prospects to grow over time, whatever the market may do? But we are more broadly cautious at this point, but we're always alive to opportunities as well.
All right. Thank you, Mark, and thank you, David, for your time.